And let's bring in former Dallas Fed President Robert Kaplan, talk about all that and more. Robert, it's great to have you back. Man, Sarah threw a lot at her. Student loans, gas prices, bond issuance, shutdown, the strike. Hard to throw her off her, I guess, sense that the economy is pretty stable at this point.
I think the economy is stable at this point, and the Fed rate increases have certainly created a tightening in the economy. Goods are weaker. Anything interest rate sensitive is weaker. It's harder to get a loan if you're a small business. But I do believe the unspent ARPA money, which I agree has been through the federal deficit a couple of years ago, but it still is being spent, as well as the Inflation Reduction Act spending, the Infrastructure Act spending currently are, to some extent, keeping the economy resilient, and I think in particular keeping the service sector resilient and the labor market resilient. And so I think you've got some cross currents here.
At this point, in terms of activity, do you think risks are to the upside or downside?
In terms of the economy?
Yeah.
In terms of the economy, my concern is this: the organic growth capability of the U.S. economy is at one level, and I think we're getting an extra boost from government spending. We're running a $2 trillion deficit this year, which is substantial when you think it's post-COVID, but pre-recession. Government debt to GDP is over 100%. And so my concern is when this government spending starts to dissipate, the organic strength of the economy is I think, weaker than we're seeing. But I don't see any sign government spending is letting up in 2023 or 2024. So I think we will stay resilient.
Robert, the Treasury Secretary, acknowledged deficits, but said the metric she watches is net interest to GDP, which at 1% she didn't seem particularly concerned about. Do you share that sentiment? Well,
I look at two things. Government debt held by the public as a percentage of GDP is now over 100%. The present value of unfunded entitlements is $75 trillion. And I think you're seeing, if you look at the 10-year Treasury and the 30-year, I think you've seen a meaningful backup in those rates over the last month or two. We're now at over 430, and I'm not sure the backup has run its course. So I think there is some market sensitivity to the fact we've got a big supply of Treasury issuance in the years to come, and we're running very large deficits, and we've got a very large debt to GDP that we have to fund in the years ahead.
You mentioned the government programs, many of which are obviously involved in just beginning to really spend a lot of the money that was allocated. Are you surprised Fed Chair Powell, when he's been asked about the inflationary impact of those programs, really doesn't seem to think it is significant?
Well, if you look at it on a deficit basis, I think the thought is the Inflation Reduction Act was intended to be paid for, and the Infrastructure Act had some pay-fors, and the ARPA money, the American Rescue Act money of $1.9 trillion, already went through the budget. I think if you look at the impact on the ground, though, and I travel a lot around the country, you see more than 15 new battery plants of $4 billion each sprinkled around the country. You see new infrastructure proposals and announcements every week. When you're on the ground in cities and towns, the impact is, in fact, meaningful, and it creates more demand for not only goods and services, but particularly labor. And that's why I think the labor force has remained relatively tight. And I think will continue to remain relatively resilient because of that.